Hello good people, it's me Kumanawa, your money manager. Today I'm standing right in front of my whiteboard because I want to answer this very important question that I normally receive from a lot of people. The question goes like, I'm in the process of acquiring my first property, I'm in the process of buying my house, and I don't know what to go with. What are my options? I don't know whether I should go with a personal loan or I should go with a mortgage. Which one is really correct? Which one do you advise me to go with? And I'm always quick to say that I don't give anyone financial advice, but rather what I've advised you that we do is let's look at the numbers. Let's work out the numbers. Let's look at the more personal loan, the terms and conditions of personal loan versus the mortgage. And once we have looked at that, let's try to create conditions or create a scenario that is more favorable for us. So this is exactly what I'm going to do. I'm going to show you the calculations, personal loan, mortgage, and I'm going to throw in some other conditions that you can look at to make that decision of whether you should go with a mortgage and a personal loan and what you should do. So let's get into it. This is the scenario that we have to look at. Let's assume that you want to buy a house and the house that you want to buy is 500,000. So we are looking at a mortgage versus a personal loan of 500,000, which is the price of the house that you want to buy. Let's look at our lender's terms and conditions. So for the mortgage interest rate, you are being offered 8.76% per annum, and for the personal loan, you are offered 12.76% per annum. Somebody might be asking, why the difference between the two? Why is a mortgage cheaper than a personal loan? There are basically two reasons why a mortgage is cheaper than a personal loan. To start with, a mortgage is what we call a secured loan. What do we mean by a secured loan? We mean that the same property that you are buying, the house that you are buying, is the asset that the bank is going to hold as security for this loan. But when we look at the personal loan, there is no physical or tangible, anything that you can touch that is attached to the personal loan. So between the two loans, a mortgage is less riskier than a personal loan. Personal loan is high risk, and that is reflected in the pricing between the two loans. And what happens with the security is that when you fail to pay, the bank can actually sell that property and pay off and use the proceeds to pay off the mortgage. They can repossess the property, sell it, and take the money to pay off the mortgage. While with the personal loan, the bank will have to scratch around, look for something that they can take to sell and possibly pay off the personal loan. So this is why the rates are different, and this is why a mortgage is cheaper than a personal loan. The other reason is that a personal loan is unrestricted, very unrestricted, in the sense that when you go and apply for 500,000 personal loan, nobody is going to question you in terms of what you're going to use the money for. The money is going to go directly into your current account, and you can use it whichever way you want to use it. Nobody's going to follow you up and ask you, what did you do with the money? What have you done with the money? Did you use it for the intended purpose of why you applied for it in the first place? Nobody's going to come and ask you those questions. But when it comes to a mortgage, the money never goes directly into your account. What happens is the money is going to pay the seller, is going to go directly to the seller. And maybe if the seller owes another bank for this particular property, that money is going to go to that bank to pay off the seller's balance at that bank. And then maybe if there's any difference, that's when the seller would get something in terms of money. And if there's also a difference between what the seller owes at their bank and then what they got, then maybe that's when you can get that difference directly into your account. This explains why their rates are different. And if you may ask me where I got this rates, because I'm sort of like using the average rates, I've looked at the Botswana Gazette today, and I'm happy to inform that most banks really have started publishing their lending rates. We know that back in the days, they only used to publish like your savings and investment rates, but they're now publishing their lending rates. So I've looked at the average of what the banks are offering as lending rates. So yeah, please make it a habit that you look at the newspapers more, especially towards the end of the month, and towards the beginning of the month, that's when they publish the rates. So this really takes away the excuse of us not shopping around for a better rate, because I know people used to say that, I don't have the time to go to bank A, bank B, and bank C, but now the information is right there in the newspapers. You can have a look at it. Let's go into the term. So for the mortgage, they're offering us 20 years, and for the personal loan is 60 years term. I know that some banks, they can even go up to 7 years for a personal loan. So really, but let's stick with the 60 years. And for the mortgage, in terms of how they get to the terms, some banks would have their own cap. In terms of the term, they would say that our cap is 20 years. So what they would do is, when you come and ask for a mortgage, they're going to look at your current age right now versus your retirement age. So if the difference between the retirement age and your age right now is lower than 20, they would default to the lower age, because the assumption is that by the time you retire, the mortgage should be out of your business. You should have cleared the mortgage. So there is no way you're going to be left with 15 years retirement and they give you a mortgage of 20 years, even though they can go up to 20 years. So I just wanted you to be aware of that. So let's look at the minimum repayment. M here stands for the minimum repayment. I always want to highlight to all of you that what the banks give you is the minimum repayment. It doesn't mean that this is the only amount that you can pay. You cannot pay lower than this amount. You can pay more than this amount. So this is essentially the amount that you have to pay for this loan to reduce in such a way that the balance of this mortgage will be zero. This is what you have to pay. You cannot pay lower than this, but you can pay more than this. The same thing applies to the personal loan. The minimum that you have to pay in there is 9,973 pula 83 tebe. This is the minimum. You cannot pay lower than this. You need to pay this so that the loan can reduce in such a way that in year 6, the loan is zero. So based on these terms and conditions, the rate, the term, let's look at the total repayment, the actual amount that you are going to end up paying by taking up these two loans. This is here the total repayment. It means the loan amount that you got, which we call the principal, the loan amount, plus the interest. For the mortgage, you are going to end up paying 1,061,218 pula 66. And for the personal loan, you are going to end up paying 718,115 pula 72 tebe. That's the total, inclusive of the loan amount plus the interest. But now let's look at just interest only, because that interest, that's the cost of you taking up this loan. That's your cost of debt. So for the interest only, for the mortgage, you're going to end up paying total interest of 561,218 pula 66 tebe. You can see that it's actually more than the loan amount itself. So double. It's more than the loan amount itself. But let's look at the personal loan. For the personal loan, you're going to end up paying 218,115 plus 72 tebe. And for these two particular reasons, where you can see the lower figure is obviously for the personal loan. Somebody would say, I would go with the personal loan. Why is this rate low, even though the interest rate given up there is high? It's because of the duration. The longer the duration or the term, duration is term, the longer the term of the loan, the higher the interest you are going to pay, because your repayment is spread out over a long period of time. Remember, interest is calculated on the actual loan balance. So if the duration is long, it means the loan is reducing at a lower pace. Very slow, very slow, very slow. This is why when you look at the surface, it's like, okay, I would rather go for the personal loan because I'm paying less in interest. But let's say if you're comfortable with paying 9,973 from pula 83 tebe, and you've looked at your income allows you to pay this amount. Let's say, okay, what about I consider a mortgage, but instead of going with their normal terms, how about I make some changes there and there? How about I pay the same amount? Instead of paying the 4,000 421.74, because remember, I told you that this is the minimum. It doesn't mean that nothing stops you from paying more than this. So, but you are gonna decide that, you know what, I'm gonna pay more. I'm gonna pay this same amount that I would pay under a personal loan, in such a way that if I pay this amount, then I'm gonna repay off this in 6 years, just like I would have done with a personal loan. Let's make those changes here. Let's make the figures. Let's just change the figures a little bit, and let's see what the impact is going to be on these two figures here, being the total repayment amount together with the interest amount. We have changed our numbers. Like I've said, you know, I'm now going for a mortgage, but I'm paying 9,973 Pula 83 Tebe. I'm basically using the same terms, these two terms for the personal loan. 6 years, I want to be out in 6 years, just like I would have with a personal loan, and I'm paying the same amount just like I would have with a personal loan. This is the impact, guys. Remember, the total repayment, which is the loan amount plus interest, is only 624,808 Pula 22 Tebe. It's actually lower than the personal loan amount because there the rate is higher. But now I'm taking advantage of this low rate. That's it. And let's look at the total interest that I'm going to end up paying. Overall interest for this one now is 124,808 Pula 22 Tebe. Remember, with the normal mortgage terms of 20 years and a minimum of 4.4, that interest was about 561,000, somewhere there. It was quite high, and it was actually double the interest that I'm paying on the personal loan. But now look at what I'm paying. The interest is even lesser than what I'm paying on the personal loan because I'm taking advantage of the lower rate. But now let's look at the interest saving that I am going to make by going with a mortgage over 6 years, meaning that I'll be paying 9,000 over 6 years, paying 9,973 Pula 83 Tebe. So what essentially this means is that I'll be paying like the 4.4, which is the minimum repayment, plus 5.5, which is going to be an extra payment that I'm making. So that extra payment is what is going to accelerate and what is going to rapidly reduce my loan balance in such a way that I'll be out of that mortgage in 6 years. I hope that is very clear, and please, if maybe I've used a term that you don't understand, please let me know in the comment section. Just let me know so I can move away from using all these big terms, because really the intention is just to simplify everything as so everyone could understand it. So 20 year, 20, Y here is the year, M here is going to be standing for mortgage. 20 years mortgage versus 6 years mortgage, right? So this is our 6 years mortgage. 20 years mortgage is, remember, the first one that we did. So here is my interest saving, over 400,000 to be precise. The figure is 436,410 Pula 44 Tebe. That's a lot of money that I'm saving by saying, oh, I like the rate, but I like the rate, but I'm not gonna be there for 20 years, and I'm not going for the minimum. I'm going for 9.9, which is the same amount that I would have paid under a personal loan, comfortably paid under a personal loan. So now I'm beating the banks at their own game. So that's the saving. It's huge, isn't it? It's very huge. But now let's look at the saving. If I decide the savings between 6 year mortgage, this the current terms here, versus a personal loan, how much interest am I going to save? It's still a lot of money. There it is, 93,307 Pula 50 Tebe. There you have it, guys. You know, they say figures don't lie. Figures do tell a story. This is why when I'm conflicted about making a decision about anything really, when it comes to my finances, I sit down and I start looking at the figures, and I'm gonna more likely to go with what makes perfect sense for me, looking at the figures. Because sometimes when you try to reason any other way, you might possibly end up making a mistake. Because when we look at it from the surface, it was a personal loan was more appealing than a mortgage because of a longer duration. But now if we are to cut that duration to 6 years, and instead of settling for the minimum, I go for 9.9, which I would have paid under a personal loan, then I am being financially intelligent and financially smart. So this is all that I had for you today. I hope that you find this video insightful. It will really help you to answer that question of personal loan versus a mortgage. This is all that I had for you today. Please don't forget to leave a like and a comment for me, and I will see you in another video. Thank you very much for your time.